We also want to get you up to speed on China. Chinese stocks falling today on worry over rising COVID cases and the impact that it's going to have on the country's economic recovery. New data out showing confidence in the job market and also income prospects, both falling to fresh lows. That is weighing on investor sentiment. You're looking at the NASDAQ Golden Dragon China Index off nearly 4% on the day. Let's break all of this down, what it means for investors as we look ahead to 2023. For that, we want to bring Kevin Mahn, Hennion and Walsh, Chief Investment Officer. Kevin, it's great to see you. So certainly another down day for the U.S. markets here. Of course, also the selling that we're seeing overseas in China. But let's talk about what's going on here, because I think a lot of hope heading into this final week of trading was that we were going to see a bit of a momentum shift and we were going to see some buying come back in. That's certainly not materialized just yet. What's your takeaway from the action that we have been seeing?
I believe that what we continue to see, Shauna, is tax loss selling coming off of a historically difficult year for both stock and bond investors. And we keep talking about the hopes for a Santa Claus rally. And I think in all likelihood, Shauna, this year, Santa Claus came early. As I've been speaking for some time about two potential tailwinds that could lift stocks higher by the end of the year. And both came to fruition. The first being the outcome of the midterm elections with a divided government. Historically, that bodes well for the stock market. And the second, of course, being the Federal Reserve shifting and scaling back the increments of their Fed rate hikes, which they did in December with a rate hike at just 50 basis points. We saw rallies after both of those outcomes, and I don't think there's any more rallies left this year for investors to look forward to.
Well, Kevin, let's think about next year and the potential for a recessionary environment. Goldman Sachs, notably not in the recession camp. They think it's going to be a soft landing, but they are in the minority here. What's your view? And if you are in the recession camp, how should investors be preparing for this?
Great question, Jared. And I would just remind everybody that the first two quarters of 2022, we met the technical definition of a recession with 2 consecutive quarters of negative real GDP growth. It's hard to imagine the first 2 quarters of 2023 being anything but trying for the U.S. economy following 425 basis points of hikes by the Federal Reserve in 2022. Their suggested terminal rate is 5%. So that means 3 more potential 25 basis point hikes in 2023, of which I think they'll do in the first half of the year. Then they'll pause, step back, and take a look at all the damage that they've done to the U.S. economy at that point in time, similar to what we've seen in the U.S. housing markets. You noted it before. Pending home sales now registered their second biggest loss on record going back to 2001. That's going to trickle through into the economy because the consumer who continues to dip into savings, who continues to put more in their credit cards, is going to have a tough time keeping up with inflated prices in the new year.
So, Kevin, what does all this mean just from a strategy perspective? Investors that they are looking to put money to work, what are some of the things that they should be considering then in the new year?
Right. And I don't want to sound overly pessimistic because my theme for 2023, believe it or not, is better days ahead, as I believe that there are better days ahead for investors, particularly in the second half of the year. But the first half of the year is going to be a difficult one with respect to economic growth. A lot of uncertainty about how far the Fed goes, how aggressive they're going to be. So investors may want to position themselves in the early part of the year more defensively in those sectors that have historically done well during economic slowdowns up to and through recessionary periods, such as healthcare, utilities, consumer staples, and then industrials. But once the Fed does stop this rate hike cycle, once we see inflationary pressures coming more under control, then look to those beaten up sectors, the technology, the e-commerce areas, and even some of the smaller cap biotechs to rebound the most during the second half of the year because they've been beaten up the most this year.
Yeah, Kevin, I've been thinking about that a lot, and I'm actually writing about it for Yahoo Finance's morning brief tomorrow. Just thinking about the Fed pivot. It's going to come, but how long is it going to last? Is the Fed likely to have whipped inflation at some point in the near future, or do we return? Does inflation be a persistent threat for years? And if that's the case, how does this change the investing landscape? Because investors have been conditioned not only over the last 10 years, but more likely over the last 20 years. We haven't really seen a sustained period of value and cyclical outperformance over growth. It's mainly been about low interest rates. So if this is part of a longer shift in paradigm, how does this play out in the investing world? How do people prepare for this?
I believe what's going to take place in 2023, once again, is that the Fed raises another 75 basis points to get to that terminal rate of 5, and then they pause, stop, whatever term we want to put on that to see the amount of damage they've done to the labor market, to consumer spending, and towards GDP growth. Then in all likelihood, they're going to keep rates at those elevated levels at least through the end of 2023. Perhaps, Jared, considering a cut at the beginning stages of 2024. So if rates are going to be higher for longer, if inflation's likely going to be with us for longer than some earlier anticipated, you should position your portfolios accordingly. And in those types of environment, look for those areas of the market that have historically done well when rates have been higher. We mentioned utilities before. A lot of people tend to stay away from utilities when rates are high. But historically, actually, utilities perform well in rising rate environments and also during periods of extreme stock market volatility. So perhaps that's an area to consider. Preferred securities, generally issued by banks or companies from the financial sector, are worthy of consideration in that environment as well. And municipal bonds, given the supply-demand imbalance that's likely to go over into the new year, certainly seem worthy to consideration for us as well, at least as it relates to income-oriented investors.
So given your theme for 2023, better days ahead, I like it. It's optimistic. Is it safe to say then that the worst of it in terms of some of the sell-offs that we've seen, is that behind us at this point? And then also on top of that, just in terms of the volatility, is that something that's here to stay, though, for the new year?
Right. So, Sean, when I say better days are ahead, I don't want people to suggest that I'm implying that inflation is behind us, because it most certainly not. I'm not implying that the Fed's going to stop raising rates, at least over the short term, because they're not. And I'm certainly not implying or suggesting that these short-term bouts of volatility behind us, because they're not. In 2022, consider this, Sean, 1 out of every 3 trading days involved a move of the S&P 500 by 1.5% or more, either up or down. That's 33% of the time. That's a significant amount of volatility. I do believe that the worst is behind us with respect to that type of whipsaw volatility, with respect to peak inflation, and with respect to peak hawkishness. So if you agree with me that those worst days are behind us, well, then clearly better days must be ahead. But how do you manage your portfolios positioning for those better days ahead, but still allowing for some downside protection to get over these chops in the road that are likely along the way?
Any way you slice it, it seems like a very different investing landscape in the coming year. Great stuff here, Kevin. Great to see you, Kevin Mahn.
Thank you.